Most people that want to trade in the market don't have time to sit in front of a computer all day long staring at charts. We have jobs, families, hobbies, other commitments. Nobody wants to sit in front of a computer looking at charts all day long. But the problem then becomes you miss out on a lot of good entries, and you probably get into stocks or options at less than ideal prices. So how do you fix that? Well, that's where the wheel strategy comes in. This is an option strategy that's perfect for those of us who do most of the chart analysis either in the evenings or weekends, after hours when the market is closed. It's a method that you can use to enter a position when the stock price is not right at an ideal entry, such as a support level. And the best part is, when you use this strategy correctly, you still have a greater than 50% win rate. So stick around after the intro, and I'll show you how you can use this strategy to generate consistent income in your account. So what is a wheel strategy? Well, the first step you need to do is to find a stock that you're bullish on. So just like any other trade, you still need to do the technical analysis on the chart, find a stock that you think in the, either short, medium, or long term that you're bullish on, you think is going to move up. Once you do that, you also use chart analysis to identify support levels and determine at which point you'd be comfortable buying the stock if it were to pull back. Again, remember, we're assuming that you're looking at a chart that you're interested in, but the stock isn't right at a perfect entry level. It's not right at support or a level where it would be good to buy the stock at the current price. Using your analysis, you figure out what price you would be comfortable buying it at. Then what you do is you sell puts at that strike price and collect the premium for selling those puts. These can be either weekly or monthly expiration. Now, once you do that, there's two possible outcomes. The first is that at expiry, the put will be out of the money. At that point, you simply keep the premium you collected and repeat the strategy again. Of course, you got to redo the technical analysis and make sure nothing's changed. But as long as you're still confident in the stock, you just sell puts again at another expiry date and collect more premium. Now, the second thing that could occur is at expiry, your puts are in the money. In that case, the stock will get put to you and you still get to keep the premium that you initially collected. This lowers your cost basis in the stock. Once you receive the stock, you immediately sell call options against it. This collects additional premium and further lowers your cost basis in your stock price. And you continue to do this, week after week or month after month, depending on which expiration you're using. You continue to repeatedly do this, collecting more premium each time and lowering your cost basis until eventually you're called away from the stock. So it's important when you're selling these call options that, again, you're using the chart analysis and you're selling it at a strike price at resistance or near resistance, so you can do this as many times before the stock gets called away from you. All right, so let's run through an example, and hopefully it'll make a lot more sense on how to execute this strategy. So we're looking at Advanced Micro Devices, ticker AMD, and let's do some technical analysis on the chart and see if this would be a good candidate for the wheel strategy. So just like everything else in the market, it's been in this long-term downtrend pretty much a whole year until around October of 2022. And since then, you can see it's been in this uptrend. Now, it's not a perfect channel, but we can draw some trend lines and you can kind of see it's in an upward channel. So let's zoom in a little on the area that we're interested in right now. We can see that the current price action is pretty much trading inside this trading range. So right now where the price is at, if we were to look at the closing price from today at 82.61, it's reasonable to assume that if the stock gets up to this $89 level, that will be at least short-term resistance. We can't expect the stock to just, shoot out through that level. So if you were to buy the stock right here, right now, or I guess, if you were to buy the stock today prior to the close, you only really have a 7.8, let's say 8% profit potential. Now, the problem with that is from this level, you also have to assume that the stock could pull back all the way down to the 75 or let's say 75, 70 level and still not be doing anything wrong, still be, perfectly in trend. Well, at that point, you're now negative 8%. So you basically have a 1-to-1 risk reward. So it's really not, it's really not a good place to be buying the stock. It's not the right price to be buying it at. Now, if the stock were to pull back down to the 50-day moving average, down to the bottom of the box, that could potentially be a much better entry. Now, there's another way of looking at this. If we remove this drawing, and let's draw it this way instead. So if we zoom out a little bit, so using this last low as a support level, if we draw our current support and extend it way out to the left, and let's just change the color so it's a little easier to see. So we can now see that this current support level is an area of significant structure. So it was resistance back here. It was resistance back here. Some consolidation around that area right around this price range. And it was strong support way back over here. So it seems like every time the price comes to this level, it has acted as either resistance or support in the past. So it would be reasonable to assume that if the price were to pull back down to this level again, that it would act as support again. Now, the other thing we can look at is if we extend the 50-day moving average, if it continues rising the way it is, and the 200-day moving average starts to level off, we can see that the 50 is going to cross over the 200 somewhere around, let's say, March 17th or so. So again, that would be a bullish sign for the stock as the 50 crosses the 200. So let's get these out of the way. One final thing we want to look at, if we draw the resistance level, so the resistance would be, let's say somewhere right around this range. And let's make that red. All right, so you can see, just like with the support, the resistance is also an area of significant structure. It's been resistance here, it was resistance here. There was some consolidation around that area. Again, more consolidation right there. It was strong support in this area. So again, both of our support and resistance level have significant structure to the left of it that indicate that we are using the right levels for support and resistance. So what does all this tell us? Well, basically the way I would look at this is that if this stock were to pull back, say somewhere down to this level, like around the $76, $77 range, I think that would be a great entry to buy this stock. There's two ways you can do this. You can either watch it and wait for that pullback, or you can do what we're going to show you here in this video, and that's use the wheel strategy. So to use the wheel strategy, you would look at selling puts at somewhere around the $77 level. So to get a better idea of if the wheel strategy would be appropriate for this stock, let's actually take a look at some option prices. What I did today is actually, I did get into a trade. It was the March 17 expiry. And so what I ended up doing is I sold the $77 puts. And the reason I did that, well, actually a couple of reasons. So first, again, we're looking at March 17th expiry. When you look over to the right side, it's actually pretty incredible how accurate the option market is in predicting the maximum price movement of a stock within a given period of time. So what this is telling us is that the option market is predicting that by March 17th, so 1 week away, the maximum move in the stock price would be $5.34. Obviously, we don't know which direction. That would, be too easy. But all this is telling us is that we can expect the stock to move somewhere around $5.34 in either direction or less. So if we take the closing price on Friday, on today, at $82.67, and if we subtract that $5.34, that gives us an estimated maximum move in the downward direction of $77.33. So that was why I picked the $77 puts. It puts it just outside of that maximum move. And also when you look at the delta at $77 puts, it's only 0.18. So that tells us there's only an 18% chance that that put would actually expire in the money on March 17th. So my strategy on this is I'd rather sell puts multiple times than to pick one, like say the $78 or the $79, where you do get more premium, but you have a higher probability of having the stock assigned to you. So I decided to go with the $77. These are the closing prices. So right at closing, the bid and the ask was 68 and 69 cents. When I entered the trade this afternoon, I was able to sell this put for 74 cents. All right, so let's go back to the chart and let's look at the two possible scenarios that could play out with this trade. So next Friday, either these puts could be out of the money, in which case I get to keep the 74-cent premium. That becomes my profit and the trade is over. So at that point, I would look at the chart again, and depending on where the price is, let's say if it pulled back, maybe it pulled back to the 21-day moving average, or maybe even all the way to the 200 or 50. At that point, I would look at the option prices again and try and find additional puts to sell for more premium. The second option, or the second way this could play out, is let's say the stock does pull back significantly enough that it pulls back below $77, and I get assigned the stock at expiry. Well, in that case, remember, I received 74 cents. So if we were to draw a line for my cost basis in this trade, it would be the $77 minus 74 cents, which puts it at 76.26. So right around this level here. So that's my break-even point. So if I get assigned the stock and it's somewhere inside this green area, inside the support area, I'm perfectly comfortable taking the stock at that level. It also happens to be right near the 50-day moving average. At that point, the 50-day will be slightly higher by next week. So my break even is actually just slightly below the 50-day moving average. So I'm perfectly fine taking the stock at that point if that were to happen. And then from there, I would immediately sell weekly calls against it at, again, I'd have to look at the option prices to see which one would make sense to sell, but I would look at either possibly, somewhere around $85, $86 around the support level, or depending on how much the stock pulled back when I got assigned, I might even look at, somewhere around the 21-day moving average. Depending what the delta is on the calls, that's what I would end up going with, something that would give me enough premium to make it worth it, but, not so tight that I'm at risk of getting called away too early. All right, so hopefully you understand how that strategy works now. Just a few more things to consider when you're using this method. The wheel strategy works best if you're in a sideways or a slightly bullish or slightly bearish market. This is because you're relying on time decay to collect premium, so you don't want to see huge moves in the stock price while you're holding either the puts or the calls. Ideally, you want to see some smaller moves, let the time decay work in your favor so you can collect that premium and continue to lower your cost basis in the trade. The problem with very bullish markets, you'll still make money using this strategy, but you won't make as much as if you had just bought the stock or if you had bought call options or say a bull call spread or something like that. So you'd still be profitable and you'd still have success with this strategy. You would just be losing out on some additional profit that you could have made if you were using a different strategy instead. Now, the problem with very bearish markets is that it becomes pretty risky to sell puts. So if you're in a very strong bearish market and you're selling these puts, even though they're so far out of the money, you're still at risk of the stock price moving way past or way below your strike price. And that puts you negative as soon as you get assigned the stock. And while it's not an impossible situation to get out of, there are some risk strategies I'll go over here in a little bit that could help with a situation like that. It's best to avoid this strategy if you're in a very strong bearish market. As far as choosing stocks for this strategy, you want to find stocks that have the right chart pattern. So again, it's critical to do the chart analysis first. You want to make sure you're picking stocks that are in somewhat of an uptrend, possibly trading sideways, consolidating, but it needs to be a stock that you're overall bullish in. So, the typical stuff like stocks that are above the moving averages are pointed up, all the appropriate technical analysis you need to do, just as if you were going to buy the stock. Now, what are some ways you can manage risk in this strategy? Now, I did say that this is a fairly low risk strategy, but just like with anything else, there always is some risk. So you can control how much risk you're taking by the expiry date and the delta that you're using. Again, in this example, I used a very low delta, so that gives me a low risk. A delta of 0.18, an 18% chance of the put expiring in the money. If you're using a higher delta, you're obviously going to get more premium, but you do have a higher risk of getting assigned the stock. The other way is with the expiry date. Weekly expirations are a bit more risky than if you were to buy an expiration that's 4 to 6 weeks out. 4 to 6 weeks is kind of that sweet spot. In this case, I prefer to do a weekly only because it allows me to repeat the strategy every week. So my personal preference is I prefer to go with a lower delta, so that gives me the lower risk, but to sell them weekly so that every week I can repeat this strategy. You could choose to do the opposite where you're going farther out in time, say maybe 4 to 6 weeks out to expiry. And in that case, you probably want to pick a little bit higher delta just to get the same risk reward or profit potential. One other thing you need to know about this strategy as far as managing risk, let's say that your put is in the money and for whatever reason you decide that you no longer want to take possession of the stock. It could be that sometime between the point where you sold the put and prior to expiry, maybe something changed in the chart pattern. Maybe you redid the technical analysis and now you see something in the chart that you no longer like and you're no longer bullish on the stock. Well, what do you do at that point? There's a couple options, but the best way to handle a trade like that is to roll the put out in time and also down in strike price. And when you do that, you have to make sure that whatever time, whatever expiry and strike price you're choosing, that you are still getting a credit for that roll. Now, this will further reduce your cost basis and it'll reduce your risk because you've just lowered your strike price on the put. The one thing to keep in mind is that rolling an option works best when the option is still out of the money. Once the option becomes deep in the money, or once that option has high intrinsic value, it's usually too late to receive a good credit by rolling it. So you really want to keep an eye on the technicals of the chart. If you see something, you want to get out early, you want to roll it early and make sure that you're not putting yourself at any unnecessary risk. And the last thing I want to go over, look, every strategy has advantages and disadvantages. So just real quick, the advantages of this strategy is it's pretty low risk. If you're executing this strategy properly, and that means doing the technical analysis first and then choosing the correct strike prices for your puts and calls, you should easily get a win rate or a win percentage of somewhere around 50 to 6%. To be honest, even higher than that is very easily achievable. So it is a very low risk trade. It's also very easy to execute. It doesn't take a lot of time. I mean, again, like I mentioned at the beginning, this is something where you can do all your chart analysis and all your technical analysis outside of hours, when the market's closed, and it really doesn't take long to execute these trades. And it's not something that you have to watch very closely. If you're checking on them daily and just making sure that nothing's changed in the chart, you'll be fine with these trades. It's also a great strategy for generating income. It's something that you can do, especially if you're using weekly instead of monthly puts. It's something you can do over and over again, and you're basically generating income for yourself every week. Now, on the flip side, of course, every strategy has disadvantages also. This strategy, it's not the best return on investment during very strong bullish or very strong bearish markets. So like we talked about, this strategy works best if you have a sideways market or a slightly bullish, slightly bearish, but not a very strong move in either direction. Another disadvantage of this strategy is that selling puts does tie up a lot of your account. So this strategy is best completed with a margin account. And ideally, you want to have at an absolute minimum $20,000 in your account, plus the margin. Anything less than that, it becomes very difficult to make any kind of meaningful profit if you have a smaller account balance than that. And finally, look, if you're looking for a big growth strategy, this isn't the one for you. Like I mentioned, this is a very good strategy for generating income week after week, but this strategy isn't going to make you rich. It's easy to use. It's consistent, and it'll make you consistent profits. But I mean, your profits are going to be reasonable. You're not going to double or triple your account very quickly. So if you consider that a disadvantage, that would be one of them. All right, well, that's all I got on the wheel strategy. Hopefully you found this informative, and this is something that you'll be able to use as one of your strategies. If you have any questions or comments, you can post those down in the comment section. We'll be sure to reply to those. And if you enjoyed this video, I ask that you please hit the like and subscribe buttons, and we'll see you next time.